So we've been talking about valuations on the retail stocks for the longest while now. Just how much of a disconnect is there in your books between share prices and the actual fundamentals within which these markets are operating?
Well, we only look at fundamental prices, and we have seen quite a dispersion across the retail sector. So there are certainly some shares that are way ahead of their fundamentals, and Massmart, in fact, is one of them. But there are still some shares that we consider fair value or just below fair value. So, there are still some buying opportunities, but we certainly don't see the upside that we saw last year and the year before. And certainly those kind of runs I don't think can be expected again. But I wouldn't say that the whole sector as a whole is overpriced.
So let's hone in on that company that is overpriced in your books, the Massmart. It's been one of the stocks that's been expensive for a while now. It's sitting at a PE of around about 41, but then continuing to prove its mettle. We had first half numbers being released in terms of sales yesterday, and sales up 15.2% to 31.6 billion rand. What did you make of that sales update that was released?
Now, that does look incredibly impressive. One does have to remember, though, that two of those divisions have a high food percentage, and we are starting to at least see quite a bit of food inflation come through there. I think the food inflation they cited was about 5%. So a good support from there, which is very important in food retail. And then the other divisions, well, particularly the building division, which did really nicely. That was coming off a particularly low base, having seen such slow demand from building products. And over the last year and continuing this year, we're clearly seeing that there is some recovery in building products. But I don't think it's only a recovery in consumer and building products. I do also think that Massmart has actually taken market share from independents and some smaller players that aren't able to hold their own in this kind of market.
Let's look at the strategy and how exactly it's winning this market share, because Massmart continues to give some of its competitors grey hairs. Just this last weekend, we saw the launch of their third extended price cut promotion. What are you making of that strategy, and more specifically, the sustainability of a strategy like that moving forward?
Well, I think that this strategy, it seems to be working for them. We can clearly see that in their mass discounters department, which is actually where that strategy is being rolled out, they've seen an incredible volume growth, maybe ahead of what most people would have been expecting. And I think that the strategy must have helped them in that. I'm not sure that they will continue with this particular strategy forever. The general feeling is that they will finally move to EDLP, which is everyday low pricing, which is the Walmart way in the rest of the world. But that may take a few months or possibly even a few years before they finally investigate whether they go that way. But this is sort of a step in that direction, that one will continue giving very low pricing to your consumers for an extended period of time, not just the one-week promotions that we've become accustomed to in South Africa.
I was chatting to a trader at the desk this morning, and he highlighted that it will be interesting to see what happens with margins. Chances are that they are increasing, and we're likely to see that when results are actually released. But with the weaker rand, I mean, we're facing a threatening scenario for margins moving forward. One would assume a weaker rand, of course, coming to bear on importers and putting those margins under pressure. What's your outlook on that front?
Well, I think definitely in this result we will certainly see higher margins. We're seeing these incredibly high sales growth, and where the like-for-like sales growth is way ahead of what one would expect like-for-like costs to be up. So that means a margin enhancement. Going forward with weaker rand, naturally one would think that would put pressure on margins, but when all the retailers are in the same boat and when they're passing through the higher cost of the product, one doesn't necessarily see a shrinking in the GP margin, and in many cases we haven't seen it. So long as everybody plays the same game, which they will try to do, we won't see a shrinking in that GP.
I'm going to pick up on what's been a laggard within the food retailing space, Pick n Pay. It's very optimistic about its strategy moving forward, especially with its Smart Shopper program coming online. How do you see Pick n Pay faring and competing in this very competitive environment? What do you make of its muscle and ability to defend its position?
Pick n Pay is a very strong brand, and their customers do like them. I don't think that Walmart at this point is a very big threat to them, because actually the only place where they would be competing would be the game food stores, and there are very few of them. I mean, at the moment I think we're looking at something like 17, and they're only aiming to roll out to 100, where we see something like 500 Pick n Pay stores. So I don't see the competition coming from there, but still it is a very competitive market. Having said that, I think Pick n Pay are focusing on the right sort of things. They have invested a lot in the loyalty card, and they tell us that it is starting to work. But you know, the other competitor, Shoprite, is also incredibly strong there, and they are going to have to perform to keep their customers.
Of course, the current market environment is very supportive for discount trading retailers that are out there, and Mr. Price is one of them. That company out with a sales update this morning saying that sales grew 15.9% in the third quarter. Comparable sales ticked up 12.5% as well. What's your view on a player like Mr. Price?
Yeah, well, that was an incredible update, given that they showed close to a 17% increase in their clothing, and that was significantly lower just a few months ago. So they've clearly done a big rebound in the last few months, got something right which they weren't getting right a few months ago. But I think that actually prospects for them are pretty good. You know, we're not expecting a disastrous year for the consumer, but we're certainly expecting a tougher year than last year, especially since inflation across food is so much higher, and that just eats into the consumer's pocket. And in that kind of environment, people tend to trade down on other products, and Mr. Price is very well positioned for trading down in clothing. It's clearly the cheaper clothing. One would maybe prefer to buy the throwaway t-shirt from Mr. Price as opposed to the 250 Rand t-shirt from one of the other clothing retailers. So actually we're seeing the prospects will look pretty good for them.
Jeanine, you were saying that we're not exactly sure what they're getting right now that they weren't getting right a year earlier. Let's explore their strategy, because they've seen some diversification come through. They've exposed themselves, of course, to that clothing segment of the market. We've seen them gain traction within the home division as well, and then on the sports front too.
Yes, well, I think that maybe that's what's hidden in the numbers is the turnaround in the products like sports, which weren't performing well at all. And the last year, Mr. Price has done a lot of introspection, sitting down, closing stores, closing space, sometimes just making stores smaller. And that was really ineffective space, which wasn't delivering a lot of sales. And that introspection possibly made things not perform so well on the front. But now that that's all done, they're really pumping on all seams, and their like-for-like sales is extremely good. It's very healthy for a retailer to do that occasionally, particularly in good times, to actually close the worst stores, and that's what they've done.
Overall, Jeanine, the current upswing that we've seen in domestic spending and household spending is one of the strongest that's been associated with a post-recession recovery since the 1970s. Does it surprise you, the kind of resilience we're seeing the South African consumer bounce back with?
Yes, I think that it was a little bit stronger than we thought. I mean, everybody expected a bounce back. One would always have a bounce back after a recession like we had. But it was strong, and it was really supported by our very low inflation. So almost any person who had a job, practically everything that the increase that they got went straight out there to the retailers. And we saw that in the numbers. So now this year, we will still expect some reasonable job inflation, or no, sorry, not job inflation, but wage inflation. But we are seeing higher inflation in itself. So the consumer is going to have a slightly narrower margin, but still we do see there will be some consumer growth. So HCE will still be positive this year, but we don't see it being nearly as positive as what it was last year.
So standing at risk of moderating, with real income growth slowing, and the boost that we've seen the consumer derive from tailwinds like low rates, expansionary fiscal stance, modest inflation, higher than expected wage increases as well, all fading. Jeanine, thanks so much for your time this afternoon. Jeanine van Zyl is retail analyst at OMIGSA.